21C sales quantity and sales mix. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our website. As you can see in the corner, St. Louis Test Preps, stltest.net, and among other things, you'll see a list of our products and services down the left-hand side. This video relates to an article that I saw in the Wall Street Journal that I thought was a great one from the summer of 2013. How companies can get smart about price increases, and the problem that's faced is how do you minimize the pain of a price increase, particularly to customers who are the most sensitive about price increases, meaning those customers whose buying behavior may change if there's a price increase. And there's two general strategies. The first one that was discussed, targeting the discounts, and we'll get to who do you target those to in a minute. And the second is selling different versions of the product at different prices to be more specific about what the product is you're selling and the price at which you sell it. So you're slicing it up and being more specific. So after we have these two general strategies, the article talked about some specifics. For example, offering a coupon when you impose that price increase. You have customers who want and use coupons and in fact insist on using them. A good example used in the article and in the media in 2013 and 12 was when JCPenney completely switched their strategy to one where they did not offer coupons and sales. They wanted to offer low prices every day, and consumers really rebelled and didn't buy product because they wanted and expected to use coupons so that they felt they were being smart shoppers by using coupons and getting a cheaper price. Seems like common sense, but explain why the price increases were imposed. I've been several places that I go to that are coffee shops over the years have put up a sign that explained why they've increased the price on certain products, and usually it's because a component part, in the case of the food business, some of the components, some of the ingredients of your food have become more expensive, and so they put up a sign and explain why they've raised a price. Time your price increase so that you time it when you're improving or updating the quality or the benefits offered by the product. And if you raise prices, people are more likely to be willing to pay a higher price if they see a better benefit by using your product or service. And back to the first general strategy, target promotions and discounts. Who is it in particular whose buying decision is based primarily on this type of offering? Who is it that really wants the promotion or discount, or they'll consider going someplace else? So the subject of that article about pricing is a nice lead-in into sales quantity and sales mix, which is a cost accounting concept. And I mention here that in the book Cost Accounting for Dummies, I cover sales mix and sales quantity in chapter 13. So let's assume you're a coat manufacturer and you make two lines of high-end coats, Tundra coats and Everest coats. And you're budgeting at the beginning of the year, excuse me, and you see that you're going to sell this many units of coats in your budget, that's your plan, and at this sales level, so if I take sales divided by units in green, I get a price per unit for each coat. These are high-end coats. I have variable costs. Sales less variable cost gives me contribution margin. We've seen that in prior videos. And then we get to a term called budgeted sales mix, which says that if I take the individual item, in this case the Tundra coat in blue, and I divide it by the total units sold in green, what I find out is that 40% of my total unit sales of 500 are Tundra coats, so that 200 equals 40% of the 500 total. That means that the remaining 60% are Everest coats. And by having a budgeted sales mix percentage, we can come up with a budgeted contribution margin per unit, in which we say, well, if I take a total contribution margin in dollars in blue, then I divide it by the units in green, I get a contribution margin per unit of $2.25. and over here it's 200. And budgeted or contribution margin per unit generally is a way of making an apples to apples comparison between two products that have different prices. What I really want to know is, in terms of for every coat I sell, what's the contribution toward profit for that coat sale, ignoring fixed costs. So it's a good way of getting an apples to apples comparison. Now, as happens in life, the actual results are different. It turns out that we, in terms of an actual sales mix, have 43% of our coats that are Tundra coats. We had originally planned on 40. 57% Everest coats we had originally planned on 60. So we can use the actual and the budgeted sales information to start coming up with these sales mix and quantity numbers. Now, unfortunately, you just have to memorize these formula. I don't know of a good way of creating a memory jogger to explain them other than writing out the formulas and remembering them. So we have a sales contribution variance, contribution to profit. There's the actual contribution in total dollars, about 115,000. Our budget, if I scroll up a bit, was 105,000 right there. So our difference is a favorable variance because our contribution margin was more than what we budgeted. Actual higher than budgeted, that's good. In terms of volume, this has to do with dollars sold. In blue, you see the actual is about 363. The budgeted up at the top is 325. So in terms of volume, we had more dollar sales than we budgeted. That's a good thing. Now we get into the tricky area, which is you have differences, variances, which is defined as difference between budget and actual costs, for a couple of reasons. You might sell a different quantity of coats than you planned, or the mix of coats between Tundra coats and Everest coats is different than what you planned, and they both can create a variance. Now, these formulas here you simply have to memorize. So for sales quantity variance, we take the difference in actual and budgeted units, and we multiply it by two things, the budgeted sales mix and the budgeted contribution margin per unit, and we come up with something called a sales quantity variance. For example, I actually sold 250 Tundra coats right here. I budgeted 200 sales in units of Tundra coats right there. My budgeted sales mix was 40% Tundra coats right there. My budgeted contribution margin per unit up in the budget was 225. So what I end up doing is, if I go down to the formula and I click on the cell, and you can see the formula at the top, it's blue minus green, that difference, and I multiply it by budgeted sales mix percentage in purple, budgeted contribution margin per unit in brown, and I get a quantity variance. And it's favorable because I had a higher amount, a positive amount, therefore it is a favorable variance because I sold more than budgeted. And you can do the same thing for the Everest coat, and in the interest of time, I showed you one example here. The other has to do with mix, more of the mix of coats. So in this case, and again, you just have to memorize the formula. I'm taking actual units, and I'm multiplying it by the difference between the sales mix percentages. So here's the budgeted sales mix. Here is the actual sales mix, 43% and 57%, which comes from right up here in the actual results for the coats. So I'm multiplying actual units times the difference in the mix percentages, and then again I'm multiplying by the budgeted contribution margin per unit, just like I did above. And what I find out is for Tundra coats, that difference in the mix worked for me. It was a positive number. But for the Everest coats, the difference in the mix worked against me because I sold more of the less profitable product. And by less profitable, we mean Everest, in terms of budgeted contribution margin per unit, was less profitable at $200. Tundra, more profitable. So what happened was, compared to our budget, we sold 3% fewer Everest coats than what we budgeted. We sold more Tundra coats. So here we sold less, we sold more of a less profitable product in total units than we planned. If you look at just the budgeted units, we budgeted 300 Everest coats. We actually sold 325 Everest coats, and that coat is less profitable once again. We budgeted 300 coats for Everest. We actually sold 325 coats for Everest. That was the less profitable product, Everest was, and therefore that hurt us. So if I add the variances for both coats, I find out that it's a negative, which means it's an unfavorable variance. So what we just saw was sales quantity and sales mix variances, and those were driven by the budget and the actual units that we have up here. And we also figured out in dollars the contribution variance and the volume variance. Contribution variance and volume variance. That's as far as we'll get on sales quantity and sales mix. Remember, if you go to the website, we have our accounting video textbooks, video instruction using Excel templates. Right now we have the Accounting for Investments course, and you can also check out the site for tutoring and links to all of my YouTube videos by type here at the bottom of the page. For example, if I click on Intermediate, there's all my intermediate accounting video links. Thanks very much for watching. I appreciate it, and we'll see you next time.